In recent times, a curious shift has been observed in the money supply. After a consistent contraction over the past year and a half, the money supply has begun to surge, contrary to expectations. This unexpected turn of events has ignited a conversation among investors and market analysts. Is the Federal Reserve, contrary to their public stance, secretly easing monetary policy? Are they playing a hidden hand in the financial markets? The Federal Reserve, under the lead of Chair Jerome Powell, has been unwavering in its fight against inflation, maintaining high interest rates. However, the recent trends suggest a possible clandestine loosening of monetary policy. This stealth easing seems to be stimulating a surge in asset prices, opening up new opportunities for investors. To navigate this landscape, investors need to understand the underlying indicators of this change, beyond what is being publicly communicated by the Fed. The Fed's strategy is a complex dance between what is being said in public and what is actually happening behind the scenes. For instance, while Powell has publicly voiced the need for vigilance against inflation, certain actions tell a different story. The Bank Term Funding Program, initiated in March 2023, rapidly increased financial support to banks. This hints at a more accommodative policy stance than what is being publicly acknowledged. Similarly, events such as the Treasury market's dysfunction in October last year have shown how the Fed and Treasury can influence market sentiment through comments rather than actions. This technique, known as jawboning, played a significant role in stabilizing and even boosting asset prices. To effectively navigate this landscape, investors should pay close attention to liquidity indicators. Key metrics include the Fed's balance sheet activities, reverse repo operations, and the Treasury general accounts balance. These factors provide a more accurate picture of liquidity in the financial system, which often gives a clearer indication of market direction than public statements. Asset classes such as cryptocurrencies like Bitcoin, tech-heavy indexes like the Nasdaq, and broader indices like the S&P 500 have all shown significant movements. These movements correlate with changes in perceived liquidity and Fed actions, highlighting the importance of monitoring these indicators. The key takeaway for investors is to look beyond the surface-level narratives to understand the deeper mechanics of monetary policy and market dynamics. By monitoring liquidity indicators and asset prices in response to Fed actions, investors can better position themselves to capitalize on opportunities and protect their investments from potential market volatility. This approach requires a blend of skepticism towards mainstream financial narratives and a nuanced understanding of economic indicators and their implications. And as always, don't forget to like and subscribe.